ExamPrep.School. FLA, Health and Life and Annuity Insurance Agent Exam. Exam code InsFL-LHA05. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Field underwriting procedures. Health policy provisions, clauses, and riders. Life application, underwriting, and policy delivery. Other health concepts. Retirement and other life concepts. Riders, provisions, options, and exclusions. Social insurance. Statutes pertinent to health insurance. Statutes pertinent to life and annuities. Statutes, rules, and regs, common to all lines. Types of health policies. Types of life policies and features. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under a typical continuous premium whole life insurance cash value growth schedule, at the end of which policy year does the cash value first reach approximately 60% of the face amount? A. Policy year 10. B. Policy year 15. C. Policy year 20. D. Policy year 25. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like, longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is C. In a standard, continuous premium whole life schedule, cash value accumulates slowly at first, around 30% at year 10 and 50% at year 15, and typically reaches about 60% of the face amount by policy year 20. Reason A is not correct. At policy year 10, cash value is nearer to 30% of the face amount, not 60%. Reason B is not correct. By policy year 15, cash value is about 50%, still below 60%. Reason D is not correct. By policy year 25, cash value has grown beyond 60%, making that option too late. Question 2. An insured age. 23 purchases a limited pay whole life policy requiring premium payments only until age 65. At the end of which policy year will premium payments cease? A. Policy year 40. B. Policy year 41. C. Policy year 42. D. Policy year 43. The correct answer is C. Under a to age 65 limited pay whole life design, the payment period equals 65 minus the issue age. For an age 23 insured, premiums end after 65 minus 23 equals 42 years. Reason A is not correct. That would imply premiums ended at age 63 rather than 65. Reason B is not correct. That calculates to age 64, 1 year short of age 65. Reason D is not correct. That would extend payments to age 66 beyond the defined limit. Question 3. John, age 40, defines his estate plan by purchasing a single premium, whole life policy funded with a $50,000 lump sum. In this scenario, what is the primary federal income tax advantage of this policy type over the insured's lifetime? A. Dividends credited to the policy are taxed as ordinary income when declared. B. Death benefit proceeds are treated as taxable income to beneficiaries. C. Cash value growth is tax deferred until distributions are withdrawn or a loan is taken. D. No policy loans are permitted, preventing taxable distributions. The correct answer is C. Single premium whole life policies allow all cash value accumulation to grow on a tax-deferred basis. Withdrawals up to basis and policy loans do not trigger immediate income taxation, and death benefits pass income tax-free to beneficiaries. Reason A is not correct. Policy dividends represent a return of excess premium and are not taxed as ordinary income unless paid out in excess of cost basis. Reason B is not correct. Death benefit proceeds are generally excluded from the insured's gross income and are not taxed to beneficiaries. Reason D is not correct. Policy loans are a common feature and are permitted without immediate income taxation, subject to interest charges. Question 4. A 45-year-old client compares a modified premium whole life policy to a standard level premium whole life policy. In the first policy year of the modified premium contract, how does the required premium amount typically compare to that of the level premium design? A. It cannot be determined until the end of the modification period. B. It is higher than the premium under a standard level premium policy. C. It is identical to the premium under a standard level premium policy. D. It is lower than the premium under a standard level premium policy. The correct answer is D. Modified premium whole life policies are designed with reduced premiums during an initial period, often 5 years, compared to level premium policies, after which premiums increase to a higher fixed amount. Reason A is not correct. The initial premium is contractually defined and known at issue. There's no uncertainty until after the period. Reason B is not correct. The initial premium under a modified premium policy is intentionally set below the standard level premium amount, not above it. Reason C is not correct. The whole point of modification is to provide reduced early year premiums, so they are not identical. Question 5. Maria reviews a graded premium whole life policy that specifies annual premium increases during the first 7 policy years. Which statement best describes the premium schedule for this policy type? A. Premiums fluctuate annually based on the insurer's investment performance. B. Premiums decrease over the initial period until the original amount is restored. C. Premiums remain constant from issue throughout the policy's lifetime. D. Premiums increase by predetermined steps annually for a set period, then level off. The correct answer is D. Graded premium whole life policies are structured so that premiums rise by specified increments each year during an initial grading period until reaching a level amount, after which premiums remain level for life. Reason A is not correct. Premium adjustments are contractually predetermined, not tied to investment results. Reason B is not correct. Graded premium schedules involve increases, not decreases during the grading period. Reason A is not correct. Submitting within 10 days is too soon. The regulation specifies a 15-day window. Question 6. In an annual renewable term life policy structured with a level death benefit, which of the following is true regarding premium and benefit features? A. The death benefit remains level, and premium rates increase at each renewal based on attained age. B. The death benefit decreases while premiums remain level for the initial term period. C. Premiums stay level for a specified term and death benefit increases annually to keep pace with inflation. D. Cash values accumulate on a tax-deferred basis, and premium is guaranteed level for life. The correct answer is A. The correct answer is that death benefit stays constant while premium rates rise annually at renewal according to the insured's attained age. Reason B is not correct. Describes a decreasing term structure with level premiums, not annual renewable term with level benefit. Reason C is not correct. Inflation-indexed increases to death benefit do not apply to annual renewable term with level death benefit. Reason D is not correct. Cash value accumulation and level for life premiums are features of permanent policies, not annual renewable term. Question 7. A homeowner buys a 20-year decreasing term policy to cover a $300,000 mortgage. After 10 years, the outstanding mortgage balance is $150,000, and the policy's face amount has declined accordingly. If the homeowner dies at that time, which amount will the insurer pay? A. The original face amount of $300,000. B. The outstanding mortgage balance of $150,000. C. The total of all premiums paid to date. D. A refund of the difference between the original balance and the current balance. The correct answer is B. This policy is a decreasing term mortgage protection contract, so its death benefit declines in line with the outstanding mortgage balance, which is $150,000 after 10 years. Reason A is not correct. A decreasing term policy does not pay the original face amount once the benefit has declined. Reason C is not correct. Decreasing term policies pay a death benefit rather than refunding premiums. Reason D is not correct. No refund of the difference is made. The benefit equals the outstanding balance. Question 8. An insured purchases a 15-year return of premium term policy with level premiums. At the end of 15 years, the insured is still living. Which benefit will the insurer provide at that time under this policy? A. Return of all premiums paid with a guaranteed interest credit. B. Return of the cumulative premiums paid without interest. C. Waiver of premium for an additional 15-year term. D. Payment of the original face amount as a cash value. The correct answer is B. A return of premium term policy refunds only the total premiums paid at the end of the term and does not add any interest. Reason A is not correct. This policy does not credit interest on the returned premiums. Reason C is not correct. Return of premium policies do not waive future premiums for an extended term. Reason D is not correct. Term policies do not build cash values and do not pay the face amount at term end. Question 9. An insured holds a 10-year convertible term policy that allows conversion to a permanent policy without evidence of insurability before the policy anniversary nearest the insured's 60th birthday. The insured is now 61 and requests conversion. Which is true? A. The insurer must accept the conversion request without requiring proof of insurability. B. The insured must submit evidence of insurability to convert. C. The conversion privilege extends through the full 10-year term without proof. D. Proof of insurability is waived if all premiums have been paid on time. The correct answer is B. Because the insured made the conversion request after the age 60 cutoff, the conversion privilege has expired, and evidence of insurability is now required. Reason A is not correct. The conversion privilege without evidence applies only before the specified age cutoff. Reason C is not correct. The privilege is limited to the conversion window, not the entire term. Reason D is not correct. Premium payment history does not extend the conversion period beyond the age limit. Question 10. Which of the following statements about the target premium under a flexible premium universal life insurance policy is correct? A. It is the maximum cumulative premium that can be paid before the policy becomes a modified endowment contract. B. It is the insurer's suggested premium to keep the policy funded at illustrated levels assuming current assumptions. C. It is the legally mandated minimum payment that must be made to satisfy the corridor requirement at all times. D. It is the premium amount required by IRS to guarantee level death benefit to age 191. The correct answer is B. The target premium is a suggested amount determined by the insurer based on current interest and cost of insurance assumptions to maintain projected cash values and guaranteed death benefits. It is not a legal minimum or maximum, nor an IRS-mandated requirement. Reason A is not correct. The maximum cumulative premium before modified endowment status refers to guideline premiums under the IRS test, not the target premium. Reason C is not correct. The minimum payment to satisfy the corridor requirement is the minimum premium, not the target premium. Reason D is not correct. The IRS requirement to guarantee a level death benefit to age 121 relates to guideline single premiums, not the target premium. Question 11. A 45-year-old policy owner selected Option A death benefit structure on a Florida universal life policy with a $100,000 face amount. After 10 years, the policy has $30,000 cash value and a $100,000 death benefit. If the policy owner elects to change to option B, how will the death benefit and net amount at risk be affected? A. Death benefit increases to sum of face amount plus cash value and net amount at risk remains constant. B. Death benefit remains level at $100,000 and net amount at risk declines as cash value grows. C. Death benefit equals the greater of face amount or cash value, and net amount at risk increases over time. D. Death benefit is reduced by cash value, and net amount at risk increases as cash value accumulates. The correct answer is A. The correct death benefit structure under option B is the face amount plus accumulated cash value, which holds the insurer's net amount at risk constant over time. Reason B is not correct. Level death benefit with a declining net amount at risk describes option A, not option B. Reason C is not correct. Universal life does not use a greater of provision. Option B always adds cash value to the face amount. Reason D is not correct. Cash value is not subtracted under either option A or B. Option B adds cash value to the face amount. Question 12. A Florida resident purchased a universal life policy that guarantees a minimum interest crediting rate of 3% per annum. If the insurer declares a current interest rate of 1.5% due to market conditions, what rate must be credited to the policy's cash value? A. 3%, the guaranteed minimum. B. 1.5%, as declared by the insurer. C. 0% because declared rate is below zero after expenses. D. Declared rate plus an additional 1% floor. The correct answer is A. Florida universal life contracts must credit at least the guaranteed minimum interest rate, so the insurer must apply 3% despite declaring a lower current rate. Reason B is not correct. Insurers cannot credit below the contractual minimum, even if declared rate is lower. Reason C is not correct. Zero crediting does not apply when a positive minimum guarantee is specified. Reason D is not correct. There is no provision for adding an extra floor to the declared rate. The contract guarantees a fixed minimum. Question 13. Which statement best distinguishes a single premium immediate annuity from a single premium deferred annuity? A. In a single premium immediate annuity, income payments begin within 12 months of purchase. In a single premium deferred annuity, payments begin after a specified accumulation period. B. Single premium immediate annuity payouts use mortality tables and interest assumptions. Single premium deferred annuity payouts depend solely on credited interest during the accumulation phase. C. Deferred annuities permit contract loans during the accumulation period. Immediate annuities allow loans only after full annuitization. D. Immediate annuities offer guaranteed death benefits, while deferred annuities forgo death benefits in exchange for tax advantages. The correct answer is A. The correct answer is that immediate annuities begin payout within a year and have no accumulation phase, whereas deferred annuities accumulate funds over a deferment period before payouts start. Reason B is not correct. This choice incorrectly implies that deferred payouts rely only on interest during accumulation, but deferred payouts also consider mortality and other factors upon annuitization. Reason C is not correct. This claim is inaccurate because loan provisions vary by contract, and immediate annuities generally do not permit loans once payments start, not only after annuitization. Reason D is not correct. Both immediate and deferred annuities can include death benefits. Deferring payouts does not eliminate death benefit options. Question 14. Tony invested $50,000 in a non-qualified annuity, and after 7 years the contract value reached $80,000. If he withdraws the full $80,000 as a lump sum, how is the $30,000 gain taxed? A. It is partially taxed as ordinary income and partially as capital gain in proportion to basis and gain. B. It is taxed as capital gain at the long-term rate, and the entire basis is recovered tax-free. C. It is taxed as ordinary income under the LIFO rule before any return of basis. D. No tax is due until annuitization, so the full withdrawal is tax-free until then. The correct answer is C. The gain portion of a non-qualified annuity distribution is taxed as ordinary income under the LIFO rule. So the $30,000 gain is fully taxed as ordinary income before any return of basis. Reason A is not correct. This reflects a pro rata approach, but non-qualified annuities follow LIFO, ordering for gain recognition. Reason B is not correct. This treats annuities like capital assets, but annuity gains are not eligible for capital gains treatment. Reason D is not correct. Earnings in a non-qualified annuity are taxed at distribution, not deferred until a formal annuitization only. Question 15. Maria purchased a single premium non-qualified annuity for $90,000 and elects immediate life annuitization, receiving monthly payments of $750 for 15 years. Under the exclusion ratio method, how much of her first $750 payment is taxable? A. $500. B. $250. C. $750. D. $400. The correct answer is B. Under the exclusion ratio, the investment in the contract, $90,000, is divided by total expected return. 180 payments multiplied by $750 equals $135,000, yielding an exclusion ratio of 2 divided by 3. Multiply by the payment to get the excluded portion, $500. So the remaining $250 is taxable. Reason A is not correct. This is the excluded portion rather than the taxable portion of the payment. Reason C is not correct. This treats the entire payment as taxable and ignores basis recovery. Reason D is not correct. This reflects an incorrect exclusion ratio calculation leading to a wrong taxable amount. Question 16. Under a typical accelerated death benefit rider with a chronically ill trigger, an insured must be unable to perform at least 2 activities of daily living for a minimum continuous period of how many days? A. 30 days. B. 60 days. C. 90 days. D. 120 days. The correct answer is C. The requirement for a chronically ill trigger is inability to perform at least 2 activities of daily living for a continuous period of at least 90 days, as defined in industry standards and Florida regulations. Reason A is not correct. A 30-day period is below the minimum duration required by the definition of chronically ill. Reason B is not correct. A 60-day period falls short of the statutory 90-day requirement. Reason D is not correct. A 120-day duration exceeds the minimum and is not the required threshold. Question 17. The cost of living rider linked to the Consumer Price Index typically uses which index to calculate the annual benefit adjustment? A. Consumer Price Index for Urban Wage Earners, CPIW. B. Producer Price Index, PPI. C. Consumer Price Index for All Urban Consumers, CPIU. D. Gross Domestic Product Deflator. The correct answer is C. Cost of living adjustments and insurance benefits are based on the Consumer Price Index for all urban consumers, which measures price changes for a broad urban population. Reason A is not correct. The CPIW covers only urban wage earners and clerical workers, making it too narrow for this rider. Reason B is not correct. The PPI measures prices at the producer level, not consumer-level price changes. Reason D is not correct. The GDP deflator tracks overall economic price levels rather than consumer-specific inflation. Question 18. An insured carries an accidental death and dismemberment rider with a $100,000 principal sum. After an accident, the insured loses a hand. According to standard capital sum rules, how is the payment determined? A. It is available only upon accidental death of the insured, not for dismemberment. B. It is a percentage of the principal sum based on a dismemberment schedule. C. It reimburses medical or hospital expenses up to a specified reimbursable amount. D. It is paid in addition to the principal sum benefit regardless of stated schedule. The correct answer is B. The capital sum for dismemberment is calculated as a defined percentage of the principal sum according to the AD&D schedule. Reason A is not correct. Dismemberment benefits are paid under the rider as a capital sum, not limited to death. Reason C is not correct. The rider pays a lump sum percentage benefit rather than reimbursing medical expenses. Reason D is not correct. It does not pay in addition to the principal sum. It replaces it for dismemberment. Question 19. A 24-year-old purchases a life insurance policy with a guaranteed insurability rider. Under standard option provisions, at which ages may additional coverage be purchased without providing evidence of insurability? A. Ages 25, 28, 31, 34, 37, and 40. B. Ages 24, 27, 30, and 33. C. Ages 30, 33, 36, and 39. D. Ages 25, 28, 31, and 34. The correct answer is D. Standard guaranteed insurability riders allow purchase of specified additional amounts at ages 25, 28, 31, and 34 without proof of insurability. Reason A is not correct. This list adds extra ages not provided by the standard guaranteed insurability rider. Reason B is not correct. Those ages do not align with the standard option schedule for guaranteed insurability riders. Reason C is not correct. Those ages exceed the typical option dates and omit the correct schedule. Question 20. A policy includes a long-term care rider that uses a reimbursement method. If the insured incurs $8,000 of covered care costs in a month and the rider's maximum is $5,000, what will the insurer pay? A. It pays a fixed monthly amount regardless of actual care costs. B. It reimburses actual long-term care charges up to the specified daily or monthly limit. C. It requires a lump sum payment at the start of confinement. D. It reimburses only the cost of prescription medication. The correct answer is B. Under the reimbursement method, the rider pays portion of actual care expenses up to the policy's maximum benefit limit each period. Reason A is not correct. That describes an indemnity method, not the reimbursement method. Reason C is not correct. The reimbursement method does not involve lump sum payment at confinement. Reason D is not correct. Reimbursement covers long-term care expenses broadly, not limited to prescriptions. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.